Welcome everyone to the 2024 Market Outlook Update with myself, Jacob Schatz. I am one of the partners at the firm, and my colleague, Pat Morris. Pat Morris is our investment manager and a CFA.
Hello.
So each quarter we've been doing these updates. If you recall, throughout the last year, our cadence has been a little bit more tactically driven. We've been looking at S&P returns, looking at fixed income returns. This one tends to be higher level concept. Certainly, we'll run into some of the technical things throughout the conversation, but we are focusing more so on our themes. So what's driving the portfolio positioning for the year? What drove those themes for last year, and then what's the certain allocation then that we've got put together then in portfolios going forward. So if you recall, themes for last year were three of them, and these are not just calendar driven. Some of these are overflows from previous year, and I think you can already see some of these may be consistent or coming over into the next year, but they were persistent volatility and moderating inflation, and then also a bear market bottom. And so that was coming out of 2022, what was positioning into 2023. Markets were less volatile than what we had anticipated they may be. There were certainly pockets, certainly driven off of rate adjustments or even macro conflict issues, but a lot more calm of a year and more productive than what we had anticipated. I think ourselves included, and many of the economists had certainly thought that we would be leading or into a recession, and then the degree of the recession was to be seen or felt, but that never came to fruition. And certainly it's still on the radar and driving positioning going forward, but certainly something that didn't come into play last year. And then certainly inflation and interest rates, that continues to be a theme into this year, but was one that was driving portfolio positioning for last year. So Pat is going to go through the themes for this year. As we look at the theme at the top, preparing, not predicting, I'm going to turn it over to him. He's going to go through some of the high level themes and then get into some of the technical data as well.
All right. Thanks, Jacob. I was a little quick there on that slide, but yeah. So our themes for this year, and the overriding theme is going to be prepare, not predict. And we can do the best we can to prepare for what's coming up. We look at a lot of data, but we never predict as the exact time of when a recession is going to happen, when a bear market bottom is going to happen. As we saw last year, it's kind of a futile attempt to do so. So the three themes that we're looking at this year is, the first one is a messy middle. Inflation seems to be range bound between 2 and 5%. That is much lower than the 9% it was last year or in the last part of 2022. So we have seen that they have tamed inflation. And what does that mean? And what does that mean for interest rates and going forward? Again, like we said, prepare, not predict. It remains kind of, problems remain acute, but the market timing is futile. Even if we had perfect timing on the economy, that doesn't mean you have perfect timing on the market. And then the last one is something we're calling concentrated consequences. There's narrow leadership, as we're all aware, in the S&P 500, which is the large cap, driving a lot of the decisions around how you position your portfolios and some of the risks associated with those positions. So our 2024 asset allocation, we'll kind of go through it right here, and then we'll kind of dive in deeper. So the first one is there's increased opportunity across fixed income. And not all fixed income, but this is the first time in a long time where people have talked about duration and duration being important. Interest rates, bonds are paying something, and interest rates are higher, and it looks like there's going to be some movement in them, so there's opportunity there. And then the narrow leadership of the market. By narrow leadership, we're talking about what has been deemed the Magnificent Seven, which is Apple, Amazon, Google, Microsoft, Meta or Facebook, NVIDIA, and Tesla. So those concentrated, last year, large returns, very big part of the S&P 500, and that drives kind of how benchmarks are built and how we, look at risk management. So, and then the mindset is coming from like a predicting for a recession to preparing for one. Not that we're saying one is coming, but there are some yellow flags out there that bear watching, just like they did last year. So we'll jump into our economic pulse. So, the one thing that people went over last year was like, what happened to the recession? There was supposed to be a recession 2023. And one of the things that economists look at, they look at many things. They can look at, we look at three leading indicators, lagging indicators, and then some kind of like real-time or current indicators. And one of the big ones that people look at is the leading economic indicator index. And as you see here, it usually, kind of not all the time, but will kind of lead us towards when is going to be an economic slowdown. So if you take a look here, as you can see, as we came into 2022, it really started to fall. And then it's kind of has flattened out. So what happened? Like, people are like, where did the economists misstep? What went wrong, or what went right? Because we're sitting here in 2024 and we look and we had a pretty robust economy in 2023. Well, without a doubt, it was the consumer. Consumer spending kind of kept it. Nobody could anticipate, any prognosticator or economist couldn't predict the amount of spending we would see by the consumer. So that basically kept the economy afloat. And so when people talk about consumers, it's always, the job market. And another indicator that people look at is the job, non-farm payrolls, or the jobs. And so this has been a classically lagged indicator. So this chart here shows that dotted line in the middle there shows when the recession begins. And then kind of what has happened 3 quarters, 2 quarters, and 1 quarter prior to it. So as you look, you could say, hey, everything looks good. Job growth was happening until the recession begins, and then it drops off, and we start seeing jobs, kind of unemployment rise, jobs loss, and stuff of that nature. Now, where do we stand right now? Well, right now we're at 204,000 jobs. So everything seems good, but looking at this sometimes is like driving with the rear view mirror. We see stuff in the past and it says, well, that was great, but forward, we should be kind of looking forward, which leads us to, the next trend, which is we watch the unemployment trend. Now, this one is kind of flipped. So what it is it's basically a 12-month moving average over the unemployment rate. So above 0 means that we're seeing higher unemployment, and below 0 means we're good employment. So, almost the opposite of what you're thinking. But so anytime, as you see the gray bars, anytime the numbers kind of go above 1, there's chance, there's nothing set in stone, but there's chance for economic slowdown. So where are we right now? Well, we've kind of come into a point where we're hovering around 0. So there's no guarantees, but this is another yellow light, and something, obviously the Fed is looking at when they make their decisions. So the question then is, where do we stand? Like, people talk about rate cuts and stuff of that nature, and how tight is the Fed already? I mean, where are we? 5.25% is the 5.25% to 5.5% is the Fed funds rate. And, something that they look at is the Fed funds less inflation. So if it's above 0, that means we're in a restrictive policy. If it's below 0, that means we're in accommodative policy. You see that long trench there where we were in a very accommodative policy. And then, post-COVID, or in the COVID era, we were, it just kind of forced into an accommodative policy. But since then, inflation has risen, and it's risen even as the Fed raised interest rates. It has now finally got to a point where the Fed funds less the inflation rate. Inflation's running right around 3%. So the real inflation rate is about 2.5%, so to speak, right around 2.5 to 3%. And like, what does that mean? Well, the average is somewhere around 1%. And then actually in the last 20 years, it's been about 0.5%. So the Fed has room to cut. They have room to cut to get down to that rate once they think that they have inflation completely under control. Now, one of the things is there are multiple paths lower, right? So there could be one place where we'll call it a soft or hard landing. Now, the soft landing would be, inflation comes down, jobs stay strong, and we go into a new economic cycle. There's been very few soft landings, but to this point, it seems like they're kind of guiding that path. There's another one where job growth ceases, inflation stays where it's at, and we have a little bit more of a hard landing. So there's multiple paths lower, and what happens is, depending on how it goes, is how the Fed will cut their interest rates, if they cut interest rates. So if we see the soft landing scenario, you could see the Fed kind of cut how they raised 25 basis points at a time and kind of guide the path. If we see an economic downturn, it's often said that the Fed rises rates on an escalator and cuts them on an elevator. So they could cut them very quickly, maybe 50, 75 basis points, to try to get things back in order. But the first cut, basically, how everybody views it, happened last November, December. The Fed, not the Fed cutting, but the market decided to cut for them. So right now, I wouldn't bet on March. Most people don't think there's going to be anything in March. It looks like it's going to be at least the May where they're starting to look at the next rate cut. So what does this all mean? Well, part of it is we don't know when a recession's coming, but they come. They come about once every 6.5 years. And even when there's not a recession, there's always a market pullback. If you look there at the second graph there, minus 10% or more, it happens about once a year. So there will be pullbacks. There will be pullbacks. There will be rallies. It's interesting to note. I thought it was a very interesting piece somebody talked about. When you talk about long-term capital or compounding of returns and being invested in the market and not trying to market time, the 8% that they talk about or 9% that they talk about, these rates of return, those include pullbacks. Those include recessions. They include stuff that happens in the market as part of a market environment. So it's not that somebody timed it perfectly and got out and then got back in when it was down at the bottom. So long-term growth includes bad days in the market, includes recessions. So with that, I'm going to turn it back over to Jacob to talk about portfolio positioning.
Great. This is the time of year that our team just went through our 10-year forecast and projection. And so what we look at is a high-level projection, starting at the asset class level first. And so what might we expect of a return over the next 10 years of a annualized return from each of the respective asset classes? And then we also measure risk in that component. And so what might, even though some of these asset classes, and why don't we go back one slide, so I'll actually jump into that a little bit. But risk is not shown here, but it's internally as we look at an optimal portfolio mixture is, even though some of these asset classes might be projecting higher returns than others, they also have on different degrees of risk. And so we want to make sure when we look at an allocation, not just at what stock to bonds are at, but also at a risk level. And so a risk budget is used to then determine what we put in each one of these pieces. And Pat will go through the actual adjustments, but at a high level, here's our 10-year market forecast update, starting with fixed income first. And so last year, as Fed was battling inflation, we did see yields across much of fixed income rise, and that improved forward-looking return assumptions. So not significant changes, but certainly, as you can see, a lot of green. So those return projections went up across the board, starting with the U.S. bonds going from 5 to 5.7, TIPS went from 4.6 to 5.2, and then you can see as it goes down towards dynamic, high yield, and global. High yield was one of the better performing asset classes last year, and so still see higher projections rising this year based off of higher treasury rate spreads that as spreads fell over this last year. And then municipal bond forecasts rose as well based off of interest rates, but so did interest rate given the structure of that market too. So it went from 5.8 to 6.3 on the muni bond space. Turning our attention then to global equity. So US all cap, that's comprised of large cap, mid, and small. Really nearly flat over the year, driven by higher valuations and modest earning growth in 2023. We saw all cap go from 6.7 to 6.5. International forecast fell in a similar accord, but also to a larger degree driven by higher anticipated volatility outside of the US valuations. International developed went from 8.9 to 8.2, and then emerging markets went from 10.8 to 10.1. At the bottom is our real assets and alternatives. And so again, we've had those, many of you have been with us for a while, and so this is not new to you, and some of you are newer to us, but we have real assets as a comprised sleeve of the portfolio, typically adding in further diversification, lower correlation to the rest of the equity portfolio. But real assets broadly struggled to keep up with equity markets as inflation fell throughout 2023. And so with lower prices and inflation remaining elevated, forecasts across those categories rose. 6.4 to 7 for real estate. Broad real assets went up as well to 7.5%. Same thing, we saw market alternative forecasts go up, and then also lastly, private equity forecasts largely just flat over the year. And Pat, why don't you touch on then just the updates to portfolios? I know many of you have seen some adjustments already taking place, and then many of you just based off of specific situations, perhaps taxes, are having individual discussions on positioning as well.
Sure. Yeah, a lot of these changes we put into a lot of our portfolios, or if you're meeting with your advisor, they'll be coming pretty soon. So the first one, we looking in our overall allocation, the difference between the mix between fixed income and equity didn't change much. Within each category, we changed a little bit, but the fixed income on more of the moderate and moderate conservative added 1% to the fixed income sleeve, and on the higher aggressive, the more aggressive portfolios, we've added 1% to the equity sleeve. So we we got out of global bonds. Most of the global bonds that we were looking at, a lot of the weight was in the U.S. equity market, or excuse me, the U.S. fixed income market. So we decided to put that into U.S. bonds. Moreover, I don't want to get this confusing, but we are still overweight to non-U.S. equity and U.S. small cap. When you go through and you look here, you see that we've increased U.S. large cap, and we decreased small cap while we increased some of the mid cap portfolios, or mid cap in the portfolios, and we took a slight amount out of international, developed, and emerging markets. And when we did this was exactly what Jacob touched upon in the capital market assumptions and the risk. If you looked at 2020, these are just measuring from 2023 to 2024, and the benchmark changed. The large cap market, the US market, became a bigger portion of the overall market. So therefore, we have to kind of, for our risk adjusted reasons, we kind of have to adjust with it. So we still like US, non-US stocks. We're still overweight to the index, just by a lesser degree, and we're still overweight US small cap, again, just by a lesser degree. So let's dive into a little bit more about the fixed income. So 2023 was a year of very interesting on a fixed income side because of the rise in interest rates, and now the more opportunities you have, and it became this cage match between fixed income and cash. And if people, for the first time in ages, people were getting returns on cash, and they said, well, I'm just throw my money in cash. Well, there's a lot to be said for it's great that cash is yielding, and if you need the money soon, it's been a huge benefit. It's been a huge benefit for people in their savings and their emergency funds and stuff like that. So that's great. But on a long-term basis, the potential return of fixed income as rates move, and now that we have some interest rates or some yields. So this is a classic chart in that to the left, the dark blue is if interest rates fell 1%. And the light blue is if interest rates go up 1%. So, the 30-year, that's very, very high in duration. And obviously, as interest rates drop, bond prices go up. And when interest rates rise, bond prices go down. So if you look, and there's some kind of comfort now because of the yield, the third one is the most important one, the Bloomberg US aggregate. So this is looking like if interest rates went up 1%, that the ag would lose 1.8%. Now, nobody likes to lose money, but that's something you can limp away from. And if it rises 1%, we're looking at a 10.8% return. So given that it seems it's more probable that the Fed will cut rates, that that portion, the fixed income portion, looks to be, duration seems to be our friend, whereas 2022 was a dirty word. And going forward, bonds are an important part of reducing risk in a portfolio, and now, the potential for return. So just kind of reiterating this fact, in the fourth quarter, when we saw interest rates kind of come down, now granted, they probably went up in the third quarter, but when we started to see the interest rates come down, the aggregate returned 6.8% and cash returned 1.4%. So now jumping into to equities, and we, like I said, we're still bullish on US small cap, although it had a difficult year last year compared to the Russell or compared to the S&P 500. And we're still bullish on non-US equities, but we're just going to dive into the Russell 2000 here. So the average return from around the bear market low, as you see there, is kind of, there's been many paths, and the average is you see nice word upwardly sloping and kind of returns well. The current path continues low. And it was a tough year. 2023 was a tough year relative to the S&P 500 for the Russell 2000. It had decent returns, but nowhere near what the large cap did. But we still believe in it, and it's a great diversifier. And one of the things that it helps with is it gives you different sector exposures. So the dark blue here is the sector exposures of the large cap, and then the light blue is the small cap. So large cap now makes up 30%, is made up of technology. And, that's only half of that for small cap. Meanwhile, if you look down at financial services, industrial, stuff that will help with a Fed easing, financial services, which had a rough year last year, as we remember that little small flash banking crisis, but it has a larger exposure to the financial services small cap does, and this could help drive returns. And the other thing is the valuation. Right now, the large cap growth portion is trading at a 20-year PE, or a 20-year PE average is 19. It's at 26.5. So it's pretty frothy. It's 40% higher than its 20-year average. Where the top 10 stocks in the S&P 500 are trading at 27%. So that's, the Magnificent Seven that we talked about in the other three. But the rest of the S&P 500, the other 490 stocks, are trading at 17.1. So a little bit below historical. So there is room in the large caps for other leadership to step forward. The PE on the Russell 2000 is right around its historical average, which is 19%. Now, if you wanted to go, or 19 times, if you wanted to go into the small cap value, and we're not saying we want to go or growth value tilts anyway, but the small cap value portion is trading at 16 to 17 times, so even less than that. So basically, what I'm trying to get at, the S&P has, you know, big leadership, has a lot of consolidated consequences. But there's other leadership that is possible in the S&P 500, and there's still small cap, which gives you exposure to different sectors and different size. So what does this all mean in aggregate? Well, let me wrap it up here. We believe in high quality fixed income. We took some money out of or some percentages out of our global bonds, some of that out of inflation tips, and put it into our high quality fixed income. While we reduced our weight to small caps, we still believe in small caps, and we're overweight to the overall benchmark weight of small cap. And the same thing for non-US equities. We still believe in them. We reduced a little bit because of risk basis, how big the US large cap market has gotten. So we still believe in those. And then lastly, as always, we are preparing. We want to build resilient portfolios with humility. We want to build portfolios that are going to work for the long term and that are going to work for markets as a whole. We can't predict when exactly the market's going to top. We can't predict when the market's going to bottom, but we can prepare for the best case scenarios.
Great. Thanks so much for all that content, Pat, putting this together and updating us on everything as it relates to, on the portfolio front. We appreciate you taking time to watch this, and we'll continue to keep you updated as the year progresses. Our team continues to work on things throughout the year on the backside and continue to monitor things as they unfold. And certainly if there's any time where we feel like an adjustment may be warranted, we'll make sure to communicate, those changes and really why and the reasoning behind those. Again, if there's any questions that you have, don't hesitate to reach out to your advisor or Pat. We will be able to cover those in more detail in your individual reviews. Thanks again.
Thanks, everyone.